Ladies and gentlemen, please welcome our second panel, Global Challenges and Trends, moderated by Gillian Tent, Assistant Editor with the Financial Times. She is joined by Sir Martin Sorrell, Chief Executive Officer, WPP Group, Daniel Yergin, Founder, Cambridge Energy Research Associates, Dan Doctoroff, Chief Executive Officer, Bloomberg LP, and Laura Tyson, Professor, Global Management, University of California, Berkeley.
Very nice. Shh. Well, good morning, everybody, and welcome to the second session of today's Exim Bank conference. Those of you who were just listening to the voice of God would have heard the introductions, but those of you who weren't will bear with me while I quickly say them again. We have a terrific panel. I know it's a tough job to follow Chairman Hochberg and David Rubenstein in terms of making people laugh and getting a lively atmosphere. But we have got a great panel for that. And starting on my left, your right, is Dan Doctoroff from Bloomberg. You've all got the CVs and bios in the packs. Next to him is Daniel Yergin, who is known to many of you as a great expert on energy trends. On my right, your left, is Sir Martin Sorrell, Chairman of WPP.
You're promoting me, Gillian. I'm just a humble CEO. Not
I'm sorry. CEO of WPP and a co-founder. And at the end of the panel is Laura Tyson, who previously served in government in Washington and is now Professor of Global Management at the University of California, Berkeley, and is also a well-known, renowned economist. So we have a good mix of economists, energy analysts, and two business people, plus people who've served in government as well, to talk about this key theme. Now, the session is entitled Global Challenges and Trends. And as somebody who's been trying to run a newsroom the last few years, there's certainly been a lot of those about in terms of the dramatic economic events and the geopolitical events as well. But in many ways, I think a more interesting prism to use to look at where we are today is not just in terms of the short term, is the economy growing or not growing, but to step back for a minute and think about the fundamental assumptions that are driving the global elite, business leaders, policymakers, many of you in the room. And as somebody who's gone to Davos for many years, the World Economic Forum, I've been very struck by a shift in mood in the last few years. Before 2007, there was a very strong sense of sunny optimism. Not just that the world was growing and would keep growing and would keep getting better, but also an optimism in what I like to call, slightly facetiously, the holy trinity of Davos man. A belief in the power of free market capitalism, a belief in the power of innovation, and a belief in globalization. And there was a very strong assumption that all three elements of that holy trinity could only get deeper over time. The world would become more globalized, more innovative, more free market capitalist, and that would essentially mean that overall global growth would go in a straight line, up. Now, that was 2007. And as we all know, in the last few years, that sunny sense of optimism and confidence has been very badly shaken. Faith in innovation, at least of the financial sort, has certainly been shaken, undermined. And not just of the financial sort. I mean, if you talk to people like Gary Kasparov and Peter Thiel, big venture capitalists these days, they would question whether innovation right now is quite as dazzling as it was a few decades ago. Faith in free market capitalism has certainly been challenged, not least because we have a world where central banks are increasingly shaping the way that markets work and where governments in the West have stepped in to an extraordinary degree to intervene in the economy and financial system. And faith in globalization only ever proceeding on a straight line has also been shaken. True, we've not had the kind of dramatic trade barriers and trade tariffs that were seen in the 1930s reappear, thankfully. But if you look at, say, the financial sector, just to be provocative, something very interesting has gone on. Now, I have 2 slides to show, and I don't actually want the first one. If you could put up the second slide, whoever is the voice of God, or the henchman of God controlling the PowerPoint somewhere. Next slide, please. Fantastic. This is a chart showing what's happened to cross-border capital flows. No prizes for guessing where 2007 is. Until in the couple of years before 2007, life was going upwards very, very sharply. And then come the financial crisis, notwithstanding the assumption that cross-border capital flows, financial globalization, would only ever go in one line. In fact, cross-border capital flows collapsed very dramatically and have not yet rebounded to where they were before. In fact, as you can see, in the last couple of years, they started to decline. So, if nothing else, it's a good moment to ask, are we correct to assume, as Davos Man did pre-2007, that the world will only ever get more free market capitalist, more globalized and more innovative? Is a pattern like this an aberration or just a pause point? Or are we about to resume? So are we actually about to see quite a significant change? And if so, what does that mean not just for global growth, but also for American companies that have been so central to this trend of globalization, free market capitalism, and innovation in recent years? So I'd like to start by asking Martin Sorrell, not the chairman, but chief executive of WPP, what do you think about this? Because your company very much has expanded on the back of the globalized dream. You know, you epitomize in many ways Davos Man.
There is a Davos woman as well.
There are a few Davos women, very few.
20%. Not enough, but they are there.
1 in 5. But anyway, so Martin.
Well, first, can I, like all good advertising agencies, I ignore the brief. And let me just go back to the question David raised, because I don't want to be controversial or offensive in any way. That's not my nature. But I did find the first session rather patronizing. And David asked a very interesting question about, is the emerging markets phrase the right? We ban it inside WPP. We call them fast growth markets. I think it's patronizing to suggest fast growth markets.
Right.
Because it's patronizing to say that China is an emerging market. It's emerged, boys and girls. It's $8.5 trillion. America is still the world's largest economy at 16 out of about $72 trillion worldwide, but it has emerged. And it is a fast-growing market. And the balance of power, as David finally got to it, has shifted. The world has changed. And the center of the world is certainly still America, but it is challenged to a very significant degree by China. And the new leadership in China, we had the privilege at the China Development Forum last weekend to sit down with Premier Li. Xi was in Africa, and first move was to go to Russia. Big message, which I think we have to understand. So I just want to make that point because I did find it. I do find these sessions, it's not just sessions in the US, I do find it in the UK and France, Germany, Italy, and Spain. We still haven't got the message, I think, and we have to understand that the world has changed. Now, moving to the brief, Gillian's questions. Free market, the attitude to the free market has changed. The growth of the stakeholder theory, which is Klaus Schwab's theory, has changed the way that business thinks. Doing good is good business. Certainly if you're in the long-term business of building brands, building corporate brands, product brands, service brands, you are going to think about all your stakeholders, not just short-term profitability. The other two things that you raise, innovation, I find, again, I think that's a little bit patronizing. I find the innovations that we find in places like Bangalore or Beijing or Sao Paulo, for example, take 3 big centers of digital development, which is a third of our business now, just like fast growth markets are a third of our business. I find innovation just as exciting, just as vibrant as before, and globalization even more so, because if I look at WPP, what is our strategic mantra? It is new markets, new media, consumer insight, including big data and the application of technology, and lastly, horizontality, which is near and dear to your hearts, getting our 165,000 people in 110 countries to work together. So I think there has been a shift, and the biggest event was Lehman. The Lehman weekend, taking one of your sort of competitors, Andrew Ross Sorkin's book, Too Big to Fail, which should be required reading, that changed, corporate behavior changed post-Lehman. not so much consumer behavior. We focus on thinking what happened to consumers. I think corporate behavior. GE Capital was supposedly within 48 hours of being unable to refinance its financial commitments. Warren Buffett called it America's financial Pearl Harbor. This was a very serious event. It has made companies more conservative. They're sitting on $2 trillion, maybe even more, of net cash, relatively unleveraged balance sheets. Corporate consciousness has changed. So strategy, let's say take globalization, is very much around the fast growth markets. If I look at WPP, where am I going to get my growth? Where am I going to get my delta? Our budgets this year are 3% top-line growth. But in Brazil, despite flat GDP last year, we were up 10%. In China, we were up in double digits. In India, close to it. And even in Russia, poor old Russia that got a little bit of a bad vibe in the previous session, I'm quite bullish on, particularly because Russia plus Poland plus Germany in Europe, to my mind, is the coming force. I shouldn't use the word axis, but that axis of those three countries is extremely powerful, and I do think there are signs in Russia, actually early signs, of Putin and the administration taking a much more long-term attitude. So, net-net, I think the free market approach, the capitalist approach, it's much more inclusive, it's much more all-embracing, it's much more about stakeholders. Innovation is very vibrant, particularly in those fast growth markets. And last but not least, global growth, understanding the sort of dynamics that the first panel talked about, is essential. It's essential for anybody running a multinational business.
Right. Well, that's fascinating. Well, I must say that one of the most electrifying debates I've ever chaired in Davos was actually on the very issue of reverse innovation, the idea that it's time for the so-called, Western world to look at innovation that's coming out of the, we won't call it emerging markets, but the fast-growing markets. And that's a very key theme that's got a long way to run. But I'd like to turn to Dan Doktorov and ask you, as a company which also very much is expanding and building on a global footprint, and which benefits if the world is becoming more globalized and free market and capitalist, how do you read where the world's going right now?
Look, we are a company that benefits from globalization and the increased sophistication. In fact, a couple years ago, we did an aggression analysis of the two factors that determine the number of Bloomberg terminals. That's our main product, not the news. And it's sold to traders and salespeople, portfolio managers. That's a whole package of information. We sell this product for $20,000 a year. We have 315,000 subscribers. And if you track that over the last 20 years or so, there's nearly a perfect correlation between the number of sales and the number of subscribers we have and two factors. One is the level of capital assets around the world, and the second is cross-border investing. Okay, so it perfectly tracks those things with nearly 100% correlation. So we obviously care. And we have a I think, pretty well-defined point of view, which is that the trends that you identified are irreversible. And we see that in the numbers. We I think, agree largely with what Martin is saying. I also come at it from a slightly different perspective. Before I came to Bloomberg, I was deputy mayor of New York and came in with Mike Bloomberg right after 9/11. You may remember he took office literally 3.5 months after 9/11 when New York was reeling. It was in terrible shape, not just emotionally and physically, but also economically. We faced this massive budget crisis. And we said, we've got to think about cycles in a different way because New York as a financial center is disproportionately affected by financial cycles. So we actually went back and looked at all of the financial crashes, panics that had occurred since New York became a financial center. And we said, in reality, there were 10 of them that were not dissimilar to what we see right there. What happened post-Lehman. In 1809 and 1817, 37, 1857, 1873, 1891, 1907, 1929, the late 60s, early 70s, really briefly in the late 80s, and then this most recent one. And they all followed the same pattern. Everybody said the same things that people are saying now. We're these forces of integration and globalization. Will they continue? The interesting thing that we observed was that in every single one of those panics, crashes, or busts, they were all actually preceded by some wave of innovation that actually got out of control. Could have been financial innovation, could have been technological, could have even been geographic innovation like the Erie Canal. And then what ultimately got us out and restored a more rapid growing economy after was something else that came along. I don't think we're in an anomalous period. I think what we're in is a period of adjustment after a period of excess. And it just takes time. That's starting to happen faster in America than it is in Europe, in large part because Europe deferred difficult decisions and has a much more cumbersome decision-making process. It has resumed more quickly in Asia because it was less affected in some ways. But really, if you look at that chart there, and you
put the chart up again.
Put the chart back up.
Can we put the chart back on?
Essentially, if you lop off the big peaks and just create sort of a line through it that would be a trailing several years average, you'd see that constant flow of integration that would be an upwardly sloping line. That is the trend of history. And I think it is absolutely irreversible, and I think we're in the process of beginning that again, but in the very early stages.
That's fascinating. I mean, as friendly rivals, I have to ask you this question. Did the sales of terminals fall off a cliff in 2008 too?
Well, 2009, there's a little bit of a lag they did, but I'll tell you something. We had 268,000 terminals at the end of 2007 before the financial crisis. We have 315,000 today.
Well, that was artfully dodged.
No, they went down briefly, and then they came right back up.
Well, let's hope that's a fabulous metaphor for business in a wider sense. But Daniel, you are working in an area where there's been intense innovation in the last few years. And in many ways, that innovation in the energy sector has helped to fuel growth. What's your reading of the picture?
Sure. First, just to pick up a little bit on Dan's history, before this latest book, The Quest, I did a book called Commanding Heights, and what comes to me in the discussion, because I came away from that because it's about the battle between state and markets. And first, I think the term free markets is a little misleading, since I think everybody knows that, take the United States. The United States is a highly regulated welfare state. It's not really a free market, as that phrase suggests. Secondly, there is, and it's interesting the way you put it, Dan, there is a pendulum that swings. And the concept that I found very useful is to think about the balance of confidence. In international politics, you have a balance of power. In markets, you have a balance of confidence. And it's swung from confidence in markets to confidence in states. And this is a transition to energy, is because in energy, so much other places, you see the state is much more directly engaged in the marketplace, be it in the United States in so many different ways, but around the world, and certainly in the energy sector, where state companies, we've seen 10 years ago, the mood was privatization. Look at different parts of the world. Now the balance has really shifted towards the state companies, partly buoyed by high prices. If prices change, I think we'd see that change. So let me turn to the energy sector, which has really been, and I will come back to the latest iteration of Davos man at the end of this, and Davos woman. But the energy sector, during this period since 2008, kind of three big things happened. Number one, the nuclear renaissance turned into the nuclear patchwork after Fukushima. Germany going to turn off its nuclear power, China going ahead almost full speed there. The second thing is the excitement about renewables has kind of run into the reality of austerity and economics. Last year, $167 billion was spent on renewable electricity around the world. On the other hand, there was a statement just 2 weeks ago by the CEO of CalPERS, the largest pension fund, saying that their investment in renewables has been, as he put it, a noble way to lose money. So it is still a transition period, and he does have to answer to his pensioners on that. But the third thing, the big thing, and the thing that you're alluding to, is this unconventional revolution in oil and gas, which had started as shale gas, it started as controversial. the thing is, and I still get this question in places, should we go ahead with it? Folks, we've gone ahead with it in North America. 37% of the natural gas in the United States now is produced by shale gas. And look what's happened using the same technology in oil. U.S. oil production, 2008, we're going to run out of oil, peak oil, the whole thing is done. Since then, U.S. oil production up 40%. 40% is equivalent to the entire production of Nigeria, a major OPEC country. So something big is happening here. And I think the change in the narrative over the last 15 months is to focus on the economic aspects of it, to see what it means in terms of jobs, 1.7 million jobs supported during this period. Secondly, what it's meant for government revenues, actually. And now what's becoming clearer and clearer is what does it mean for competitiveness and the competitiveness nations. So if we go to the latest iteration of Davos man and woman, Davos person, the question that I found throughout Davos this year from European businessmen is we have enough problems and now we have to compete with the United States because the United States is going to be much more competitive because of relatively inexpensive energy. I even hear that in China, in different countries. So I think that's a big change. And one question is, does this revolution, how fast does it spread around the world? And this is exactly an innovation that people thought couldn't be done. It was 20 years in the making. It snuck up on people, and the bell only rang, ironically, in that same year, 2008. So one last part to mention about the integration, and LNG is a very big concern for many people in this audience. 40% of the project finance debt that has gone into LNG has come from export credit agencies because of the tightening of commercial credit. And we see the gas market, that global gas market is the LNG market's going to double, and it will probably be larger than the US market. The need is there. The world gas consumption is going to converge with oil and coal somewhere in the 2030s. But the big question, and for many people in this room, is what will be the price of gas? And that depends upon whether you're going to have strong exports from the United States, real buildup of supply, what will happen in terms of where the other gas will come from. And there are a lot of other sources of gas. And last point, I thought our discussion a little bit was set up by the gentleman who asked the question about Canada as an emerging market, because it is going to be a major exporter of LNG. And I think it is true that Canada is let's put it this way. It was an emerging market a century ago, but it will be an important force in this global gas market, which ties people together.
Well, thank you. There's a huge array of fascinating issues and themes to unpack there, and I'm sure that people in the audience will want to ask questions about that later on. But I'm going to turn to Laura now and ask you, as someone who looks at the global economy and has looked at patterns of trade flows and things like that, how optimistic are you about the process of globalization continuing? Okay. And are there any practical steps that governments cannot do at the moment to try and ensure that growth is maintained?
So I am optimistic. I do believe that the forces that have driven us to unprecedented levels of globalization, historians of globalization have sort of measured it in a variety of ways: capital flows, trade flows, people flows, idea flows. And by every measure that we can come up with, we are a more interdependent, globalized world than ever before in terms of countries, in terms of people all around the planet. I don't see the technology that enables that being reversed. And so I think a driving force here is the technology which has brought us together. I also think that on the issue of markets, I agree completely with Martin that we have, and with I think Daniel, that basically free markets are a concept that's a wonderful textbook concept. It's never really what markets are about. We have moved in many of the developed countries and some of the developing countries towards, or emerging countries, if you will, towards more of a stakeholder aspect, and I think that stays with us. But the key thing is that countries around the world, all of the countries which were discussed in the first panel and that Martin has talked about, have basically continued to embrace market-type solutions. That has not changed. The capital market I would put aside for a minute. I agree with that we came through one of the world's great financial crises. And every single country that had to deal with the consequence of that is trying to figure out how to regulate its financial markets. It's a very important question. So in that area right now, there isn't a consensus. There's a developing set of thinking institutions. How shall we regulate those markets going forward? But in other markets, I think what you have seen is that if you think about the beginning of the 2000s and the creation of the WTO and China joining the WTO and the countries around the world that embraced market-type solutions, again, I don't see any of that reversing during this crisis. I think we're rethinking capital market regulation, and we need to because that line, the peak, was not sustainable. That was the crazy part. That looks just like the housing prices in the United States. But if you think about it, all right, I think the trend.
Perhaps we can put the chart up.
Well, it's that crazy peak. Yes. So looking at that peak, you'd say that's what's wrong. It's not the sort of steady line behind it, but that's wrong. So I believe that globalization has not been reversed. We're at a peak point, that we've slowed a little bit in thinking about capital market integration, but that's a matter of rethinking regulation. And I don't see any sign in the world's economies in general of moving away from markets. I think the concerns about innovation, I did not find those arguments that we somehow or other, there's something, we don't have great ideas anymore, there's not an innovative spirit. I did not find those articles compelling at all. In the United States, we have major technology developments in just happening around us. I mean, no one really knows how big data is going to transform every single thing we do, starting from how we deal with medicine to how we close our energy off at night. This is fundamental. Education. Martin and I were talking just before at the table. I remember John Chambers in 1998. I was dean of the Haas School, and John Chambers was convinced that education was about to be transformed by technology. Now, he was wrong by a decade or so. But I think if you look around right now and see the amazing things going on at the university level, the research level, the K through 12 level, the pre-kindergarten level, in terms of what the use of technology to help people learn, fundamental. And the business models for education, fundamental change.
And unleashing tremendous capabilities.
Absolutely, around the world.
Nicholas Negroponte putting iPads into a Somalian village, coming back 2 months later and finding 7-year-old kids hacking into
So watch out.
Unbelievable. Watch out.
Watch your security. So basically, I'm an innovation and technology optimist. Okay. So that goes to the issue of finally just saying that on globalization right now, I do think we have to recognize that before the crisis, and certainly since the crisis, the emerging markets, and I will use that term because I can't think of anything better right now, we're actually already growing significantly faster than the developed countries. Martin, you may not remember, but he used a few years ago in the middle of the crisis, he suggested that there were going to be several kinds of recovery lines. There was going to be the V. That was the emerging markets. They were going to fall quickly and come up quickly. Actually, they have recovered. They're past their peak levels of output. Some of them never lost their peak levels of output. They just slowed down a little bit, and then they took off again. So the V actually held. The U.S. is kind of a U. We're coming out now. We coming out slowly, but we're coming out steadily. And I think you put Europe in
we had love.
The love.
We could. That was
the flat. Europe
was
was going to flat line, is basically what Martin said. And Martin, that was a pretty good love analogy, I think. The truth is that the emerging markets survived that crisis. They went into it growing faster than the developed countries. They came out of it growing even faster relative to the developed countries. And really, for the U.S. and Europe, I think we still have some way to go. And I will just end with a kind of macro thought here. Recently, Ben Bernanke gave a speech, a lot of his speeches are very well publicized. This was on long-term interest rates, and it was a bit kind of academic. But he said on the basis of his reading of where long-term interest rates were, long-term inflationary expectations, over the next 10 years, markets do not expect a strong recovery in Europe. They do not expect a strong recovery in Japan. And they're still skeptical, pretty skeptical, about a strong recovery in the US. All of those countries still have substantial amount of work ahead of them in terms of debt consolidation, fiscal consolidation, dealing with demographic challenges to their budget. So I think going forward, the fast growth economies are still going to be in the rest of the world, and the gap may be even bigger than it's been in the past.
Well, thanks, Laura. That's very helpful. I often think if you're talking about letters of the alphabet to describe the economic trajectory, my favorite one is actually more like a saxophone shape for the Western world, in the sense that it went down very sharply, came up a bit, and then flatlined. Okay. And if there's anybody in the audience who, like me, ever studied shorthand as a rookie reporter, you'll know that if you go down sharply, do a hook, and then flatline, you're writing the word bank. It's true.
Bank.
Couldn't make it up. So we've had a bank-shaped recovery in the Western world. But Martin,
yeah, I just want to add on from what Dan said and what Laura said, or the two Dans. Dan twos.
The College of Dans.
The College of Dans. It comes back this thing about the US, and I want to get some balance into it, because I think what's really interesting is what has happened. That's my phone going. Thank you very much.
It's probably an emerging market government calling there.
Anyway, no, what I want to say is there's a really interesting report, which I think is available online, which is done by an offshoot of the CIA for the president or the re-elected president every 4 years. And the question that they answer is, what will America look like in 20 years' time? And this time round was really interesting if you read it, because it said two big things. One, the thing that Dan obviously focused on, which is self-sufficiency in oil. So in 20 years' time, Saudi Arabia is not America's problem, it's China's problem, it's India's problem. So that's one thing. The other thing is the manufacturing efficiencies. And the one that it highlighted particularly was 3D printing.
3D printing.
Digital 3D printing. If any of you have seen these techniques, they are incredible.
Scary.
They're absolutely scary. And they will reverse this sort of manufacturing flow that we've seen to the lower cost economies. And even China is becoming higher cost. You're talking more and more about Vietnam and Bangladesh. And I remember clients of ours saying 3 or 4 years ago, China was already becoming too high cost. And I remember one packaged goods company saying to me, we're looking at investing in new plants in Bangladesh and in Vietnam. The other thing I just want to say is about regulation. I went with Hank Paulson and 7 other CEOs to the China Advanced Leadership Program in Shanghai. It's the sort of the Harvard Business School of SASAC, the government holding company, which has combined turnover of $2.2 trillion, up from about $1.8 trillion, I think, a year or two ago. And we sat with the 40 SOE chairman for 2 days. And, you know, the Chinese sit there and they listen, they learn, they take notes, they don't fall asleep. And they really take it. Now, the interesting thing is we had a private dinner with them, several of them. And we said, you know, how do you feel about running a company where the state is the single shareholder? And they said they feel it's very difficult. It's very difficult. They feel that there is a discount, or there is certainly no advantage in taking risk. And what they want to see is more freedom. They want to see more, you actually use the word entrepreneurial energy and engagement. And I was thinking, as they were talking, which way are we going? We're going completely the opposite direction. And the Chinese, I think, will secure an even greater advantage. And we heard it from Premier Li last week. He talked about the 12th five-year plan. He talked about consumption, the switch from savings. He talked about the social security safety net. He talked about the growth of service businesses. And what he said was really interesting. He said, and Chinese service businesses will be competitive with Western businesses as well. So this, I see the world increasingly, from my perspective of WPP, as being increasingly a G2 world, in the sense it's those fast growth economies and the US, Never underestimate the US. Never write the US off. Human resources, entrepreneurial energy, natural resources, $16 trillion. It's still twice the size of China. But the bit in the middle, to Gillian's point, Western Europe, UK, France, Germany, Italy, and Spain, that's less so Germany, I think, for the reasons I mentioned before. I think that's the real structural issue.
It's the flat line.
Absolutely.
Can I just say one other term here that hasn't been brought up, but it's been implicit, actually. It was mentioned in the first panel when people talked about foreign direct investment being attracted to the United States. And it is implicit in discussions about companies beginning to think about how much should they continue to offshore. And that's the term reshoring. And I want to bring this up because if you take the difference, the improvement in energy costs, the fact that the labor cost differentials have come down pretty dramatically in some of the that benefit the emerging markets. You think about the scale of the U.S. and you think about the openness of the U.S. I actually think, and there was just an article this week, I think, about a German company saying, well, we got to bring our production to the United States now because we're so energy intensive that the only place to do this business is in the United States. But think about China making that huge investment. China has those huge reserves there in cash form that it needs to convert into other kinds of investment forms. And I think, Martin, to your point, those companies, when they come here, they actually can acquire entrepreneurial talent, they can acquire new technology, they can acquire a change in the way you do business here, and it's very attractive to them. So I actually, even though I said markets are, I think if you look again at long-term interest rates, there are market skepticism about the strength of the U.S. recovery. I think that it's likely to surprise now a little bit on the upside, and it's going to be sustained. And so that will differentiate. Again, I think of it as a kind of G2, the fast growth rest of the world. The U.S. has sustained recovery with a lot of interesting new things going on, and the real problems are Europe and Japan.
Right.
Can I
I'm
say-
going to, yes, please.
I mean, two examples of this, which are, if we continued on this trend, I went out to see the governor of Ohio 2 days ago, and he's kind of reeling in companies from all over the world now who would not have thought of investing in his state before. And the other, and somebody that's well known to people on this panel, is the CEO of a major company who says basically he's going to invest $5 billion in the United States. And he said, if you told me 3 or 4 years ago I was going to invest $5 billion in the United States, he said, I would have been dismissed from my job. So that's the kind of change that is beginning to unfold in the global economy.
Right. I'd like to ask you, Dan, given what we've heard about how the landscape's changing, do you have any piece of advice for American companies that are looking at the non-American world at the moment?
Well, I think it's hard to generalize about advice to American companies. Everybody's situation is so completely different. I don't want to repeat what everyone else has said. I'm an optimist about America. I think our long-term competitive advantages are both cultural, resource-based, intellectual, and we're going to continue to lead the world. Will that mean that our market share is actually going to decline? Absolutely, it has to, because the emerging markets are growing off of a smaller base than we are, and they're going to grow faster. Does that mean that we won't continue to grow on an absolute basis? Bloomberg's a classic example. We only have 37% of our revenues from the United States. By the largest share of our customers, though, is by far in the United States. Everyone is worried about sort of the rise of Dubai and Shanghai and Singapore and Hong Kong as global financial centers. And yes, if you look at the number of Bloomberg terminals in those markets, they've been growing faster. The absolute number of customers in New York over the last 5 years, 10 years, 20 years has grown more, the absolute number, than the rest of them put together. So the reality is that as the world grows, if our companies are thoughtful, smart, build products for local markets, you're going to see significant amount of growth, particularly in those intellectual capital industries in the United States, benefiting from it. And so that is a big part of why I'm an optimist about the U.S. I do think that for all the wonderful things that are going on in the rest of the world, Martin highlighted many of them, we certainly benefit from them. The reality is that there is something very special here, and we need to leverage what's great here, take advantage of it by being sensitive to what's going on locally.
Yeah, but I think what's really interesting is that despite all our optimism, companies are very cautious. I look at our clients. Profits as a proportion of GMP, I think, are at a world record, Guinness Book of Records height. Now, why is that? And why are companies so cautious? They're confident because their balance sheets are much stronger than pre-September the 12th, 13th, 2008. They're sitting on all this cash. They're relatively unleveraged. And I look at it as these gray swans. So the gray swans are the known unknowns. Cyprus is a black swan. The interesting thing about Cyprus is I can't remember anybody even a week before Cyprus. I was told that President Putin in January at an IMF meeting did say to the assembled host, what are you going to do about Cyprus, which was an interesting comment with the benefit of 2020 hindsight, but nobody focused. So that's a black swan. But if you think about somebody running a company, a multinational, what do you face? You face Eurozone. This year at Davos, we felt a little bit better. Draghi, Super Mario didn't do anything, but just said something, said he would support the euro. Felt a bit better about that. Middle East, Iran, we probably feel worse about that. You have some of the things, even this morning, going on in North Korea. So politically, you worry particularly about the Middle East and the Iranian nuclear capability. China, hard, soft landing. BRICS, hard, soft landing. I feel it's very much a soft landing. All the data we're getting out of China. China's our third largest market. We have 16,000 people, $1.4 billion revenue, 15% market share. We feel much more bullish about China and the new leadership, very bullish about the new leadership. Fourth quarter of last year and the first 2-3 months. So I feel a bit better about that. So that gray swan has got whiter. Middle East has got blacker. Eurozone's got whiter. The US deficit, I'm sitting here in Washington. Everybody in this room knows far more about it than me, but I feel very concerned about that, and I think we all feel concerned about the lack of will of the government to deal with it. And the fifth gray swan from a British point of view is the EU referendum, which is a political decision by David Cameron, probably right politically in terms of trying to deal with the UK IP, which has got 16 or 17% of the electorate, but it introduces another element of uncertainty. You take all that little lot together, plus the black ones that we don't know about, which are the unknowns, and it makes anybody running a company very cautious. Right. Average life of a CEO is 4.5 years in America, 3 years worldwide. A CMO, the people we deal with, the chief marketing officers, 2 years. Corporate governance, regulation, there's no reward in taking the risk. So you eke it out.
Right.
And I don't think it's a surprise we have high levels of unemployment.
Right.
Because you're not going to take on fixed cost. You're just going to eke it out. You're going to take down cost. Finance and procurement has too much power inside companies, I think. I would think, from whence I come, I say that. I'm talking my own book, but I think it's true. And there's no limit to what you can do on the top line, but there is a limit, in our view, to what you can do on the bottom line.
Our clients, who are the large global, all financial institutions basically around the world, as I've been talking to CEOs of them over the last several months, I've definitely noticed a change in attitude. And it may be subtle, I don't think so. Increasingly, words like turn the corner, light at the end of the tunnel, cautiously optimistic are creeping into the discussions. And when you actually probe a little bit deeper, they think this year is going to be a pretty good year. Are they going to hire a lot of people this year? No, they prefer to capitalize on the cost savings that they've made. Are they beginning to feel that pressure to hire people back? Yes, they are, with the expectation that you're going to see actually more significant hiring in 2014. Fundamentally what they're saying, and again, this is the financial world, but I think we all understand the link between financing capacity and the progress in the real economy, is fundamentally what they're saying is the ground is really beginning to harden. The regulatory regime is becoming clearer, more so here than in Europe. And as a result, for the first time in years, they're actually really beginning to look forward in a way that they weren't able to, having to fend off all these different crises over the last 5 or 6 years. That, by the way, is more true, again, among American institutions. Daniel talked a little bit about the American coming decades in terms of energy. I actually think when you look at American financial institutions and their relative competitive position, you're going to start to see a broader expansion globally because they actually have the capacity relative, especially to their European competitors right now.
Wow. Well, we have time for a few questions, just a few. I think there are some roving microphones. It would be courteous, but not compulsory, to identify yourself. Please make it short, and please indicate to whom you would like the question to be addressed. We've only got a few minutes, so let's try and get any comments or questions as quickly as we can. Anybody want to ask a question?
I have one here.
Right.
I'm Ken DeGhetto, by the way, former chairman of Foster Wheeler. One of the things that was not addressed by any of you gentlemen and ladies, but was in the last issue, is the weak dollar. If you're investing overseas, the weak dollar is against you. If you're exporting overseas, the weak dollar is your advantage. What do you think is going to happen to keep... I'm in favor of a weak dollar, even though I travel to Europe quite often. What do you think is going to happen to it?
That's a Laura question.
Laura. Is it time for competitive devaluation of the dollar?
So a couple of things. First of all, I always say when asked about the policy to the dollar in the U.S., that the U.S. does not have an exchange rate policy. The executive branch and the central bank are not focused on the exchange rate. That is not their target. Their target is the state of the U.S. economy. The central bank, the Fed, has made it clear again and again and again, subject to criticism from the rest of the world, who says you guys are involved in a weak dollar policy. The Fed has said, and I agree with them, no such thing. We are doing everything we can with every conventional and unconventional monetary policy at our disposal to get the U.S. economy back to its potential output. It's still 8% below potential. We're still, not producing $900 billion a year of goods and services we could produce. The unemployment rate is still much too high. The Fed is using its policies to try to get rid of the unemployment problem in a quicker fashion, and is looking to inflation and saying, there's no evidence out there that for the foreseeable future there's an inflation issue. So that's the Fed's position. Now, where else could the dollar be where else could there be dollar policy? Well, I suppose the Treasury could try to engage in dollar policy, but the truth is that except for saying things, I was in the Clinton administration for 4 years. What did Bob Rubin say every single time? He said, we are for a strong dollar. What did he mean by that? He meant we're for a strong U.S. economy. And when the U.S. economy is strong, the dollar will be strong. Having the dollar depreciate gradually in real trade-adjusted terms relative to large trading partners like China, that is what you'd expect to happen based on economic theory. So a real depreciation, again, on an effective basis is something you would expect. Right. So I really think we should not accept the notion that the U.S. has a policy, or that right now we are using policy to try to make the U.S. more competitive on the basis of the currency value. The currency value is determined in the markets. We are running policy to try to restore the economy to its potential, reduce the unemployment rate, and in doing so, not trigger any inflationary pressure.
I don't think currency is a primary determinant of investment policy inside major multinational corporations. We have a natural hedge in our risk, our revenues and our costs being a service business match one another. But I think the basic determinant is risk reward. And the fast growth markets are higher risk, true, corruption issues, whatever it happens to be, but higher reward. And if you look at that, when somebody says China or India, I say all of the above. BRICS and Next 11 or Next 10. You have to knock out Iran. But it's BRICS and Next 10 are where the heart of our company geographically is going to grow.
Right. Well, I must say, given the news out of Japan this morning, and given the ability of the Eurozone leaders to keep messing things up, the chance of the dollar weakening dramatically anytime soon is not that high anyway.
No.
But any other questions? Lady in red over there.
Thank you. It's a great panel. I'm the SBA regional administrator for this Mid-Atlantic region. So it's my goal to increase exports and imports and everything that has to do with global trade. But I grew up in the Foreign Service, and we tend to, as a country, invest more, about 30% of our budget on defense and 1% on diplomacy. So when we talk about leveling the playing field, I think that we need to go ahead and look at what else do we need to do from a foreign policy to be able to, for our companies and for our commercial markets, to feel comfortable in those emerging markets, fast growth countries. So what do you think to that, balancing what we're talking about here with foreign policy?
Well, obviously, a stable foreign policy in which the United States is not looked upon with disfavor is a helpful backdrop to any American company that wants to do business outside the United States. But it's no substitute for doing the hard work of being in the country, developing relationships, having products that are responsive to the local markets, and selling. And then listening to the customers and keep refining the product. So diplomacy is a part of it, our relationships is a part of it, but at the end of the day, fundamentally, we've got to do the work.
But I think we do see, I think your point is you see even the other OECD countries, you see their ambassadors at work, and they're much more economic ambassadors for the economy as well as ambassadors for the nation state. And you can see that here with some of the European countries who feel that they're being disproportionately penalized by U.S. authorities, and their ambassadors here are out there trying to help.
But I think
do you want the American ambassadors out there championing the cause?
Can I say, this was an issue that was brought up both, and I had the honor to serve on President Obama's Economic Recovery Advisory Board and then his Jobs Council. This was an issue that the business leaders really brought up immediately, and actually there has been some things that have been done. They're small, we have budgetary constraints, but actually there was a National Investment Initiative introduced, I think, 2 years ago, and basically both in the Commerce Department and in the State Department, there was a commitment to do more training and put more resources of people in the field into economic statecraft issues, to really do a little more selling, because basically what happens is, a German trade mission will go to work on a deal, and many, many government officials will go. I suppose here Fred may go by himself. I don't know where Fred is. But the point is that there was a recognition both in commerce and in state, and there is something called the National Investment Initiative, and you can go and look up the website and see what it is that those two agencies are now doing, and it came from pressure from the business community voiced through the Jobs Council, and the president did with the Jobs Council anything he could do by executive order or executive action within agencies that didn't require legislative approval. So I think this is real, and of course the Exim Bank, as we've heard this morning, has been very active in the area of really expanding its portfolio to the small business community. So I think the U.S. is doing a little better on this score. Could we do a little less defense spending and a little more spending here? I tend to think so, but that's a very big issue. But I think we're doing a little better. And then the fact that we're more attractive now for the reasons that have been alluded to here suggests that we may have more engagement from the rest of
But I think it's a very interesting question, because at a time where America has to decide what it's going to do about a more balanced budget, it's clearly going to have more priorities from a foreign policy point of view. At the same time, China, whilst we've been focused in Britain and the US and the Western Europe on Iraq, Iran, Afghanistan, the Middle East, the Chinese have penetrated Africa, they are supposed to have 800,000 people in one way or another in various African countries. I'll just give you one little anecdote. So I was at Santos's, so I don't do brief stuff. Santos's
okay, well, your microphone gets cut off.
Santos's inauguration. He announces in his speech that he's going to build 1 million houses in Colombia for lower middle income Colombians. Who did the Chinese have as their delegate for the inauguration? The housing minister. They have an understanding that is unbelievable, and they think it through. So I think the question you ask is really interesting. America has to prioritize, and it has to deal with another superpower that is really thoughtful and doesn't have the constraints that it has.
Well, that's actually a great point, and I think it probably cuts to the core of many of the themes that are going to be debated today at this Exim Bank conference. I mean, from my part, I have sort of really three key takeaways from this discussion, which has been fascinating. Point one is that faith in innovation and globalization is still very strong. Point two is that the role of the state and free market forces, however, is up for more debate at the moment. If nothing else, blind faith in free markets alone is something which has been challenged in some countries. But thirdly, I think all four of you are pretty darn optimistic. As a journalist, I'm pained to be cynical and gloomy, but I'm certainly outnumbered here. So it's a great note on which to end, and I hope you enjoy the rest of the day. Thank you.